Welcome to episode 7 of Real Estate with the Carters. I'm Annalyn Carter.
And I'm Christopher Carter.
And together we are the
Carters.
Welcome to episode 7. We are so excited. We're filming our 7th episode.
7.
Can you believe it, baby?
Yeah, lucky 7.
Lucky.
Lucky 7, yeah.
Yes.
A lot of work.
Yes, it is.
Yeah, far more work than we
anticipated. Definitely.
Just to do the research, put the videos together.
Yes.
Finding time to do actual
record.
videos. To record.
Yeah, it takes time.
Takes time. And so for persons who do this like on a daily basis or do this
as
a job, we applaud you.
Yes,
definitely.
We do.
It's a lot of work.
Yeah.
But without further ado, let's jump into today's topic.
Okay, for sure. So today we're going to be discussing how does my credit score affect the mortgage application.
All right. And this has kind of come to light in recent months with interest rate being where they are. Persons are very more focused on what their credit score is.
Right.
Because as you can imagine, with this high interest rate, if your scores are low, then your rates are going to be extremely high. So
right.
Yeah, just let's dive right in and let's kind of share our thoughts and give some information. All right.
Okay, let's get into the topic.
All right. So first, what is credit?
All right. So credit, right? Simply put, it allows you to borrow money that you have to pay back later on. Right?
Yeah.
So typically the amount of credit or money that you can borrow is based on your credit score.
Based on my credit score.
It's based on your credit score.
So like my score is like 580.
I wouldn't be with you if you had a 580 credit score. I'm sorry, people.
All right. So what is actually my credit score? What's this credit score? So this credit score is a number. It's usually range between 0 and 850. And it's based on your credit history, your credit worthiness, how you've paid your bills, the mix of your credit. So there's a couple of stuff that goes into it. Now, a credit score, like I said, it ranges from 0 to 850.
Right.
0 is credit you're invisible.
Okay.
You have no trade lines. You're not reporting to any of the bureaus, the main bureaus.
So I was gonna just say that. So who scores you? So they're right.
So there are bureaus. The main ones that are used by lenders, the Equifax, the Experian, and the TransUnion.
Right. So they give you like a scorecard.
A scorecard, and it is based on your activities, stuff that reports to them, right? Now, an excellent score is anywhere between 800 and 850.
All right.
All right, and good, fairly good is anywhere between 670 and 639.
Okay.
All right, so that's
anything below 730. I mean 670 is not a good score.
It's an okay score, but in terms of you getting like the best
credit rate,
the best interest rate,
definitely.
It's going to, you're not going to be in the top tier. You're going to be somewhere down in the middle.
Okay.
All right. So FICO, and so most people when they're doing their mortgage, the term FICO comes up,
okay.
right?
What is FICO?
What's your FICO score?
Okay.
What's your
FICO score? my FICO score is in the 700.
Oh, well, please, yeah?
Or anyway, so FICO stands for Fair Isaac Corporation. I'm not sure who Isaac is, but right? So that's what FICO stands for, right? So it's a calculated method that they use to, I guess, to score you. So it's like based on the information that's collected on your credit report, gives you what your FICO score is, right?
Okay. So as you rightly mentioned, FICO is a Fair Isaac Corporation, and what they did, they really was a pioneer in giving the rating system that we're using now. They were the pioneers of putting really that together. And so there are actually 10 versions of your FICO score.
Oh, wow.
So that is why when you go to like a Credit Karma,
or
a Credit Sesame, or one of those other independent,
or Experian has their own reporting system.
Right. Those scores different because they may not be pulling from using the same FICO, right?
As a lender would.
Right. So because one may pull, say, use FICO 2. The lender typically use FICO 8 and upwards.
Okay.
Some of those times, most of those times, those are the reporting like the Credit Karma, those are the reporting side. They may be using FICO 2, or they may be not even using the FICO system. So that is why when we pull the score as lenders, the client may say, but I look on my phone and my phone tell me that my score is 700.
Right.
But it is that we may not be using the same
system.
FICO, the same FICO system. We may be using FICO 8 to 10. They may be Credit Karma or whichever bureau or whichever bank or platform that you're using may reporting pulling from a different FICO. So that's really what the difference is. Most lenders since 2020 has been using FICO 9 or FICO 10, right?
Okay.
So FICO 10 was introduced in 2020, and it was introduced to kind of take into consideration some other factors. And it's the FICO 10 is mostly what the mortgage lender is going to be pulling from in assessing your credit worthiness when you apply for a mortgage.
Okay.
All right. Now, how is your FICO score determined? So there are a couple of components that are within your FICO score. The first thing, which is 30%, is your level of debt.
Okay.
Right. So if you have a lot of credit cards and your credit cards are all maxed out, then your scores are going to be low because the 30% of your debt, of your usage, is what makes up the score. Okay. All right.
So typically you should be using 30% of whatever your the loan amount or the amount that you borrowed.
Right. So if for instance you have a credit card with a limit of 10,000,
okay,
we typically recommend that you try to stay below the 30% of that score, right? Because 30% of what goes into your score is your how much of your debt, how much of your credit limits you're using.
Credit usage.
Right, credit usage, correct.
Okay.
Another 10% is new credit.
Right.
So if your credit, if every 2 months or so you're putting
getting a new credit card, or applying for a new
for new loans and anything that pulls do an odd pull on your credit, right? Then that is going to affect you negatively. Okay. Right? You don't want to be putting your credit too often. Okay. Right? 35%, which is the largest percent of it though, is your payment history. Right?
So if you pay your bills on time or if you're not paying on time.
Right.
Right.
So if you pay on time, then that is going to positively affect your score, and obviously your score is going to be higher. If you don't pay on time, then you're going to see your score decreasing. Right. All right. 15% is your credit history length, which is how long you have these credit cards, how long you have your car note, how long you have whatever your mix is, how long those you have established those credit. Typically, 7 to 10 years, you put you in a good situation. Okay. So if you have like your card, so I tell people this all the time: if you have an old card that has history, try to clean up that card, but don't close the account, because then that history is going to go away. You want history.
It'll fall off of your credit history, and it won't calculate in that 15%.
Correct, and so you won't get that boost from that from having that card for a lengthy period. And the last 10% of your credit score is your credit mix. What that is how many different types of credit you have. So like for instance, installment loans are different from credit cards, different from a car payment, different from a mortgage, student loan. So the mix, so if you have only $300 limit card, that's not a great mix. Right. You want a couple credit cards, you want an installment loan, a car payment. Those having that good mix is going to positively affect your score.
So like he said, all those different factors, the credit history, the credit mix, your usage, the
Right.
length of the level of debt. They use that to add up to get
Get
a
your score.
your FICO score.
Correct. So all of that is factor in determining what your score is.
Okay.
So it's not just one thing. Obviously, all five areas that we talk about: the length of debt, the new credit, the payment history, the credit history, and the credit mix. So all five categories are important. Obviously, some are more important than others. The payment history is the most important.
Okay.
How you pay your debt. So if you're someone that doesn't pay on time, you're always missing payment, then that your score is going to be way low than somebody who pays their bills on time. All right.
Okay. All right. Got it. So now we're going to talk about several variables that affect the credit score, right? So like we discussed before, how many credit accounts you have, right? How long you've had this credit account, right? We recommend not to close an account if you had an account for a credit card for a long time that you're not using. We recommend that you don't close that account. Probably just charge a small amount and pay.
Keep it revolving. Keep it going because it's going to impact significantly your score.
Right. And how close you are to your credit limit, right?
Definitely.
So typically we say it's 30% usage. To try to keep your credit usage.
Credit cards, especially on your credit cards, right?
To 30%, right? Not to maximize
Don't max out the credit limits,
right? And how often you pay your payments on time. And how, again, negatively, if you pay it late, they look at that too to make sure that you're not making late payments.
And late payments in the credit world is payments that are made after 30 days after the due date.
Right.
Right? So it's 30 days, 60 days, 90 days, and over 120 days. So once you make the payment prior or before the 30-day cutoff window after the invoice date, then you're fine. Once you make the payment before. If you make that payment after 30 days after those invoice dates, then you're going to have a negative mark, a derogatory item on your credit. And that's going to definitely affect your credit score.
Right. And then lastly, the credit mix. So having a revolving credit card, having installment loans, having a car payment, right? Those are variables that they use.
Correct. And depending on which loan you're applying for, you're going to see how that affects that equation, all right?
Because different lenders look at different things, not just the credit score.
So it's not just a score.
Okay.
The score is a part of it, but if you have no good body of credit, like you only have two $300 credit card, then you may not be able to get certain loan because some lenders actually look on the number of activities on your report, right? And recently I was doing a loan and a client had 2 trade lines. That specific lender requires you to have 3 active trade lines at least 12 months, right? So again, the different lender based on the loan type that you're doing is going to look at your credit report, not just a score, but they're also going to be looking at the activity. The body on the report.
Okay.
Now they did a recent study, and this was done in 2020 to see, what credit, if the credit score really works.
Okay.
And what they found is that persons who have a credit score of 610 and below had a 17% chance of missing a payment, right? And which makes sense because if you pay all your payments on time, the likelihood your score or your credit score is going to be over 610, right? So it was just it basically verifies that the scoring system works. It showed that persons who have a credit score over 770, they're unlikely to miss a payment.
Okay, so they have 100% payment
their bills history. Their payment history is on par, and it just validates the scoring system that it works. Okay, it's a good indication. I know specifically for some clients of mine who have rental property, when they pull, someone's credit report, they don't even look at what's on it. They look specifically at the score itself. And if the score is 650 and above, they are more comfortable in renting as opposed to a score in like the 580.
Right.
It just
because it just says that this person pays their bills on time.
right.
Right.
It tells something about the person.
Right. And a good way, like what I do personally, like I have my and a lot of people I would say a good way of making sure that you pay your bills on time is having an automatic payment.
Yeah, I'm there's something that I'm a big fan of is making sure that you set the minimum payment
on
automatic.
Right.
And it comes out. Even if you want to pay an additional payment after you make the automatic payment, that's fine. But at least if life happens, sometimes you have emergencies, sometimes you're caught up with doing
right, you forget
to make a payment, and obviously the payment history is 35% of your score.
Right. So like you say, just make sure that minimum payment is an automatic, so that way you don't miss a payment. And if you want to pay more, you can always go back right?
and correct
and pay more
and make those
right,
payments.
And make those payments.
But don't it's advised, don't make a payment after 30 days after the due date, because if you do that, your scores are going to be severely affected.
Yes. All right. So we're going to take a quick break. All right. And when we come back, we'll go into get into more topic of how the lenders look at your credit score.
Definitely.
That affects your interest rate.
What we'll be doing in the second segment is actually linking all of that information on what the credit is and what the scores are to an actual mortgage application, and to see how it's really affected. All right. So join us back in a couple of minutes. See you soon.
See you soon.
Life is full of challenging decisions. Finding the right mortgage company should not be one of them. We at Loans Hub Mortgage and Finance are leaders in residential mortgages, refinancing, and investment property financing. We have a loan solution for your every need. Call us today at 954-947-8662, or you can find us online at www.loanshublending.com. Your next approval is just a phone call away. Loans Hub is an equal housing lender, NMLS 2220747.
Welcome back to Real Estate with the Carters. I'm Annalyn Carter.
And I'm Christopher Carter.
All right. So in this segment, we are going to talk about what credit score do you need to have for each mortgage program, right? Because there's different mortgage programs out there, and each program that there is requires a different score.
Correct. A different minimum score.
Okay. Minimum score.
All right.
So
let's jump right in. Okay. So let's start with the favorite loan type, which is an FHA loan. Actually, an FHA loan goes down to 500. You believe that?
No.
Yeah. So you can actually get an FHA mortgage with a 500 credit score. Not advisable though.
Okay.
Those rates and those points that you may have to pay to get that loan done. And then there are very few lenders that actually do those loans. But generally, you can get down to a 500. Most lenders want your score to be minimum 580.
Okay.
Now, bear in mind also that below 580, you're required to put 10% down.
I was going to say, does that require a bigger down payment?
It's going to require you to put 10% down below 580. So in most cases too, below 580, a lender may not want to even do the loan.
Okay.
There are very few lenders that do those loans, and those loans are costly in terms of points. All right.
So
now,
the second one.
Yeah. So conventional minimum score requirement is 620.
Okay.
However, it's again, each lender have their own requirements, right? So despite Fannie and Freddie require 620 minimum, lender A may say, okay, I'm only going to be taking application that is 680 and above. Lender B might say their application starts at 640.
Okay.
So, but the minimum for a conventional loan is 620. Again, while the minimum allow you to get in the door, it the price you pay to have those minimum scores in terms of interest rates and points can be very strenuous, very difficult. So my advice always is for a conventional loan, you want to be at least 640, 660.
Okay.
Right? A VA loan, it's VA scores. So VA requirement, they're really not a minimum on a VA loan. However, again, most lenders may not go below 580. I've seen a lender go 560 on a VA loan. Again, it's going to be case by case based on the lender.
Okay.
But typically, the lender is going to want you to have at least a 680.
Okay.
580.
580.
On, you're applying for a VA loan. Some lenders I've seen, their minimum score requirements on their VA programs are 600.
Okay.
Again, it's going to be based on the lender.
All right.
USDA loans is another loan type too. They require 640. Most lenders require a minimum of 640 on a USDA loan. And then you have on the non-QM side, those varies based on the lender, right? However, most lender typically 600. I've seen.
Okay.
I've seen loan below 600. Again, those rates and those points, can be quite a sum if you're below those scores. Now, again, these are minimum requirements, right?
Okay.
I've always recommend that you do everything to be above those minimum, especially somewhere anything above 680 is where you start seeing the better pricing in terms of the interest rates. So I always recommend trying to aspire to get your credit score up into those regions.
680 and above.
680 and above.
All right.
All right. Now, which score is used to underwrite the mortgage? Because there are three main bureaus that are used, and that's Experian,
Equifax
and TransUnion, right?
Right.
Now, typically, though, we use what is called a mid score.
Okay.
And the mid score is not the highest score. So let's take this example. Your Experian is 685, your Equifax is 679, and your TransUnion is 687. So we have 685, 679, and 687. 687
so the median score
is the highest.
Right.
Right. 685
is the second.
Is the second highest, and 679 is the lowest. Right. So just going off of what we just said, the one that falls in the middle
is a 685.
Is a 685.
Right.
So they're not going to be using your highest of the three bureaus,
Okay.
or they're not going to use your lowest of the three
They
bureaus.
use the middle.
They use the middle score. All right. Now,
I have a question. What if you only have two scores?
so if you have two scores, they'll use the lowest of the two scores.
Okay.
All right. Now, which credit score is used to underwrite a mortgage if there's two people?
Right. They would use the lowest.
The lowest of the two
persons, yeah,
right.
because they have the most risk.
Correct. And so what I've seen in a lot of instances when there are, more than one person on the mortgage, person A may have a 700 mid score.
Okay.
Right?
And say I have a 680 mid score.
And then person B is in the 500.
Then the credit score that the lender's going to be using is a 500.
It's a 500
because they have the higher risk.
Correct. And so a lot of time the client, Chris, why can't we use my score? Because my score is 700. Unfortunately, we're not the ones that determine which scores are used. Those are set by the lenders, and it's the lowest of the two.
Right.
or the lower of the two.
The
right?
lower of the two.
The lower of the two. So if there are two persons that are on the mortgage or three persons, the lender is going to look at that score. That score between the two persons, that is the lower of the two. Okay. All right. So I recommend in cases where there are multiple people, husband and wife, brother and sister, family, whatever the combination is, to try and get both of your scores up.
Right.
To kind of be close as possible to equal, right? Because like if Ann and I buying a house, I don't think I may want her on my mortgage.
Funny. Don't listen to him. It's not funny.
Right, but you understand the point. Is the lower of the two.
Right, and my score is not that lower than yours.
So it's very very important. Again, if you have multiple people, two or more, that you find the one that has a lower, and to see what you can do to pull that score up.
Right.
Right. Before you actually apply for the mortgage, you want to kind of have an idea of where the scores are, and so that you know what works need to be done to pull.
So then you should just monitor your credit report, right?
Right.
Make sure that there's correct information on there. Like you said, then make sure that the score is at a good level. Right.
Now, and this is especially now with rates being in the high 7s and 8, the difference between having a 680 score and having a 780 score can be as much as $300-400 a month in interest payment. That $300-400 a month that you're going to be paying extra could be used to pay for a car, could be used for college funds, for emergency savings, retirement, whatever. So it's utmost important that you do whatever it takes to get your score above the 680, 700 region, and to keep it there. Monitor your score. Like my bureaus, they're all locked. If God forbid somebody steals my wallet or my identity, all my bureaus are locked. I mean, because I know the importance, being in the mortgage business, I know the importance of having a good score. And so I'm do everything in my power to ensure that my score is kept where it is.
Okay.
All right. Again, the difference between having a 680 and a 780 score is enough to possibly pay for a car.
Right.
Right. So you definitely want to try and make sure that you're in the try to be in the upper 680, 700. Now, just going into this example, buying a 300,000 house with paying 5% down. In today's market, your interest rate may be somewhere in the 7.6. Now, if your credit drops 80, so 80 points from 780 to 700, despite you're still in the 700 club, right?
Right.
Your payment is going to be at least $100 more.
Right. So the interest went from about 7.6 to about 7.8.
So, right, but that small difference,
right, makes a
big. Right.
Yeah, it's a big difference.
It's a big difference.
And how much your interest rate is and how much you're paying in interest on a monthly basis.
Correct. So my advice as usual and as always is do whatever it takes to get your score and maintain your scores at or above 680.
Right.
All right?
Okay.
All right. Now, how can I build my score?
Right.
Oh.
Make your payments on time.
All right, so that's one thing, and that's really I remember just going back to what we mentioned, that your payment history is 35% of your score.
Yes.
Right?
Yes.
So you definitely, I can't say this enough. Make your payments on time. if you can't pay the entire payment, the entire balance, at least the minimum payment.
Right.
And I'd mentioned previously, put everything on automatic.
Yes.
Right?
Even if you're just making the minimum, like you said, right?
If you're just making a minimum, put it on automatic.
Right.
It makes a big difference.
Right.
Number 2 is keep your spending below the 30% of whatever credit facility you have. So, for instance, if you get a credit card of say 10,000, don't go max it out and spending 8, 9, 10,000. Try to keep it 1,000, 2,000, 3,000 max, because then the more you use is the more it's going to affect your score.
Right.
Right.
Right. And then pay down the high credit card. One thing that you can do, right, is to transfer. If you have a high interest on a credit card, you can transfer it over to a credit card that has probably 0 interest,
Correct.
an introductory period,
Right.
or very low interest. So you transfer that over
that balance.
right, to keep your high balance down.
Correct.
Right.
And that's a good point. I know, especially on the business side, there's a lot of, also on the personal, but I see it mostly on the business credit side, where there's a lot of introductory 0% for a year, 0% for 9 months, 0% for 18 months. Utilize those if you can. If you have large balances on personal, utilize those on the business side, using moving those balances over. You move it from your personal, so it's no longer reporting on your credit. Okay. That's 1. And 2, you can take advantage of those introductory 0% down and stuff like that.
Right.
Now, check for any errors on your credit report.
Yes.
There are times when there identity theft, there's stuff that comes on your credit that it's not relating to you.
Right.
There's sometimes old stuff that is, was resolved.
Right.
But for some reason, they're still showing up on your credit report. You want to make sure all of those, anything that is not current, anything that is not relating to you, anything that you think is erroneous.
Yes,
right?
erroneous.
You get them removed.
Right.
You wanna have your credit report as current as possible.
Right. Another thing you can do is work with a credit counselor or a credit repair specialist.
And that's important. If God forbid you have bad credit,
right.
You have credit below 680, get the services of a credit repair person, credit counselor. See what they can do to help you to remove derogatory items from your credit. Right.
Right.
Just going back to something before is. You can get a yearly report at freecreditreport.com.
Yes.
You can also use some of the other site like the Credit.com or the Credit Sesame and those other reporting agencies. Sometimes your bank also can give you a credit report without having an ad put on your credit. Utilize those credit reports to keep abreast of what's going on your credit, right? And that is going to give you a good reflection of the activities on your credit.
Right.
All right.
Put in a fraud alert on your credit, which,
that's
like Chris says,
is important. All right. Again, dispute any derogatory items on your credit that you don't recognize or it has nothing to do with you or something that was resolved in the past. You want to get those matters resolved, right? Limit your application for new credit. I know, like, I saw on a credit report recently for one of my clients that within a span of, say, 3 months, they applied for like 20 cards. And
that affects your credit score.
Of course it does. It does, right? And so 10% of your credit is new credit, applying for new credit. So the more you apply is the likely it is that your credit score is going to be going down. The lenders are going to look at you to say, or potential lenders are going to say, this person is erratic with their credit. They're just applying for credit. They're just applying, left, right, and center.
Okay.
So they definitely want to reduce the amount of new applications that you put in. And then last but not least, check your credit score frequently.
Okay.
Again, utilize Credit Karma, Credit Sesame,
Experian.
whatever it is that you can have that doesn't have an ad put on your credit. You want to utilize those reports. Go to freecreditreport.com. You can get on an annual basis a report,
Get a free report.
a free credit
once a year.
report once a year, and that you can use to kind of monitor and check what's going on your credit.
Okay.
All right. Oh, does your credit score affect your mortgage? That was our initial question.
That's the initial question.
All right, so let me tell you out. So no score or low score may prevent you from getting a mortgage.
So if I have a low score, which is like you say below, what is that, 620?
So depending on the type. So for instance, if your score is 580 and you're applying for a conventional loan, then you won't be able to get approved because you would need at least a 680. Most lenders not even going to approve you at a 680, but at least you need a 680 to even entertain getting a conventional loan. If you have no score at all, if you're invisible, then you have mortgages that you can get with no score, but typically FHA, conventional and non-QM loan, they're going to want you to have a score, all right?
Okay.
A low score will get you
A
higher rate.
interest rate, right?
Right?
Result in higher monthly payments.
Correct. Especially in today's world where the interest rate is almost at an all-time high in recent, well, not at all-time, but an all-time high in recent memory. Like, so within the past, say, 10 years.
Right.
Right. This that we're approaching really high figures. 9 and 10, people are thinking of 9 and 10 soon. Now, if you're at a 580 credit score and you're applying for a mortgage, then those interest rates and those points that you have to pay the lender to do those loans are going to be exorbitant. So my suggestion is try and get those credit scores 680 and above.
Right. Does having a low credit score too affect your PMI?
Of course. So if you're doing a conventional loan, so on an FHA loan it does not, because FHA loan is simply on the price of the loan amount. It's just simply on the loan amount.
But
right?
if it's conventional?
If it's conventional, one of the factors that goes into calculating your PMI is your credit score.
Okay.
And if your credit score is below 700 for conventional, your PMI is going to be high, right? And that's going to affect your monthly payment. It's going to affect whether or not you can afford to pay this mortgage, right? Because then that's an additional sometimes $300, $400, $500 a month in addition to principal and interest, taxes, insurance. That's another bill in addition to those. So you definitely want to make sure your score is 680 and above. Another way that you're having a low credit score can affect you in your mortgage application is that it may require a lower score may require you to put more money down. So, for instance, if you're doing like a non-QM loan,
you need a higher down payment.
If your score is say below 700, you may not be able to do 20% down. You're gonna, the lender may require you to go 30, 35% down. So having a lower score is definitely going to affect your loan to value, right? Your down payment is definitely going to be affected based on that lower score. Again, there are some mortgages that, for instance, like conventional, as I said, a 580 score, you're not going to be getting approved for a conventional mortgage. Likewise, for the non-QM, there's some products that require you to be 680 and above. Having a 580 score you're gonna be denied. If you try to apply for a mortgage having that score.
Right. So that score you mentioned before, the 580, you can get an FHA loan with that.
Definitely, but you're gonna be restricted
right.
to a FHA loan, typically with a 580 score.
Right. So the lower the score is, it's likable that you don't have a lot of loan products.
Correct.
That would
limits what you can access.
Right. There you go.
Right.
Exactly. So limits the loan products that you can access.
Correct.
Okay.
Correct. So again, most lender typically looks at a 680 and above as a good score, not a great score.
Right.
But that is when you're gonna start seeing better pricing.
Okay.
So you definitely want to get again your scores. I can't preach this, I can't reiterate this enough. You definitely want to have your scores 680 and above.
Okay.
Below that, you're going to run into difficulties in terms of higher interest rate, higher PMI. You may not be able to access certain products because those products may require you, or the lender may require you to have to put bigger down payments. All right. So that has kind of brought us to our end of today. Show. So let's just kind of walk through some of the salient points from what we discussed today with the credit scores. So
it's very important that you monitor, right, your credit score.
Definitely.
Like we know that everyone has a unique situation, but it's important that you stay on top of what your credit score is, right? Whether it's 0, 850, right? It's just, you just need to monitor it.
Definitely. And sometimes, especially if you're applying for a mortgage for the first time, you want to, prior to applying for that mortgage, you want to 6 months prior to when you're ready to do that mortgage, you want to kind of look at your credit reports, see what you can start, which debt you can start paying down, what negative item you could possibly get removed, working with a credit repair person. But you definitely you don't want to find out when you apply for the mortgage because it may be too late.
Right.
So you want to take preemptive steps where you monitor and when if there's issue, you put a plan in place to eradicate or to mitigate those risks. And therefore, to get your credit score 680 and above.
Okay.
All right.
So like we mentioned before, your credit score affects the interest rate that you can get on a loan.
Your interest rate, your access to credit, your PMI, your LTV.
Okay.
All right. So it affects a lot.
Right.
All right. And having a 680 score is okay. Right?
It's not great.
It's not great, right? But at least you're starting to see better pricing as opposed to a 580.
Okay.
The difference between a 580 and a 680 could be $200-$300 a month more in interest payment. That could, as we mentioned before, could be your emergency savings,
kids' college funds,
travel.
Right.
Right. You could be saving that money for something more meaningful. Now, one of the things that I always suggest to my clients is if you're applying for a mortgage and now your scores are low, if it is that you definitely want to move forward, what you want to do is the moment you close on your loan, you start working on bringing down, whatever issues you have on your credit, derogatory stuff. You want to start clearing them up, and then you can refinance 6 months, a year later. Okay. Right? So we're not saying no.
Okay.
If you have bad credit, we're not saying no, you won't be able to access a mortgage. What we're saying is that if your score is low, then you definitely want to either prior to or immediately after, you want to kind of look at those scores, kind of start working through those issues, resolve them, and then you could refinance your mortgage and get a better payment. Because again, the payment $300-$400 a month extra in interest payment is a lot of money that could be used for something that is more beneficial.
Right. Okay.
All right.
So I was gonna say, if you're watching this video, right, it's maybe that you're probably getting ready to apply for a mortgage. So definitely reach out to Chris.
Right.
Right.
I have a very good credit repair person that I work with. He's very good at getting credits cleaned up in a very quick very timely manner.
Okay.
All right. He has worked with quite a few of my clients, and he has gotten the job done.
Okay.
So again, it's not no, is let's see what's on the credit. Let's get those credit reports.
Let's get you prepared.
Get you prepared. Get the free credit report, and from freecreditreport.com, and let's review those credit reports. Start if there's items on it that
Start
you're
mitigating.
not. That either it's old or it's not you, or was a result of identity, whatever the reason.
Medical bills or anything on there that can be removed.
Correct.
Start
making those preparation.
Mm-hmm.
All right. Now that has brought us to the end of today's show.
Yes, it is.
Right. Thank you for joining us on episode 7 on Real Estate with the Carters.
Yes. Again,
right.
Please like, share, subscribe, click the notification, guys. You click the notification bell so that way that whenever we post, we upload a video, that you don't miss an episode. Right. All right.
And we are thankful for your support. We thank you for those who have called us, have questions. Whatever the questions is, please feel to reach out to us.
Yes.
We're more than happy to answer those questions, and whatever we can do to help you in your journey to either buy your first home or your first investment property, we're very willing to assist you.
Yes. All right. My contact information again is 786-214-1436. That's my phone number. You can reach me before 10 p.m. I'll definitely answer.
Right.
All right.
And my number is 786-985-1383. That's 786-985-1383. If you have any questions, any comment, feel free to reach out to us. We'll be more than happy to assist you. All right. Thanks a lot for joining us, for tuning in.
And we'll see you next time.
See you next week with episode 8 on Real Estate with the Carters.
Yes.
Bye for now.